So it's not as important to understand the IRR calculation. It's important you want to just know what the number is. How to figure it out, it's not relevant, it's not important. I think it's more just for osmosis. See how it works over here. This was the most expensive part of all the calculators on the app. I was building a simple way to do an IRR calculation. There's no normal Excel spreadsheet that will give you an IRR calculation. It's very sophisticated to do it. I'll explain to you the concept of it. The IRR stands for internal rate of return. It basically takes the average return that you're going to make over the life of the investment and tell you what the interest rate is. So let's keep it simple. If I make 10% year one, 11% year two, 12% year three, I averaged out at 11% IRR. So cash on cash, how much money I took out each year, IRR averages it all together. However, what gets it complicated is, and there's the example on the paper here, is I bought the building for $1 million. Same building we're going through, at $1,050,000 in closing costs. I get cash every single year. I can make a return. Then in 5 years from now, we sell the building. So not only did I get my cash back, I just got a one lump sum because we sold the building for more than I purchased it for. So even though 1 year, that last year, I got a crazy return. How do they average out the whole entire return? How does it work out to an even number, an IRR? When you go and you buy, and you go into a bank, and you see sometimes an interest rate that is an APR that incorporates the fees to compare apples to apples, they want to show you, banks want to have to show you by law what it really works out to. So if someone's gonna, like, now they play a lot of gimmicks with going on to airlines. You could buy a ticket on certain airlines, and then plus you have to pay to actually book your seat. Then you have to pay for your carry-on. Then you have to pay for a suitcase. You have to pay for everything else. So it's not really fair when it's say $70 for your ticket, because a regular person boarding this plane is going to take a piece of luggage or a carry-on bag, so your cost is really $110. The next airline is selling a ticket, including that, for $98. It's cheaper. So that's where regulation starts coming in, when someone figures out a way how to price things and have hidden fees. IRR is to be able to show you in a mathematical calculation. You're speaking to the most sophisticated investors, they focus on, I don't care if I'm making year one, year two. For the life of the investment, what's my return going to be? So I'll go through it pretty quickly. I'm not going to spend a lot of time in it, just enough through osmosis you understand how it works. The top left corner of the page. Purchase price, $1 million. Closing cost, $50,000. Total cost, $1,050,000. The deal we've been using till now. Loan to value, 75%. So the loan is $750,000. Term of the loan is 5 years. Amortization is 30 years. Interest rate of 4%. These are the facts of this transaction. And it comes out, equity requirement is $300,000 as an equity requirement. So you put $300,000 into the deal. There's $1,050,000 minus the $750,000. That's how the money comes through. On the right side of the page is the assumption for down the line. When you will eventually sell this property, what is the cap rate you're going to use? In this case, we're projecting a 6% cap rate. This has nothing to do with the reality of what the market's worth. This is based on if I'm making an investment to figure out what your return will be, what's your exit? My exit is I plan on selling the building. And I'm going to sell the building at a 6% cap rate. So whatever the NOI will be in the year that I plan to sell, I'll apply a 6% cap rate. It will tell me the value I think I'll sell it for at that time. What projection of closing costs are you going to use? I want to use 3% of my closing costs. This number is totally arbitrary. You can say, no, when I sell a building, my cost is 2%, 4%, 8%. The rest of the page is just going to calculate based on that how things are going to work. What the calculator also does by us, so it's not scientific, but the Eastern calculator does, it asks you another question. Where do you think the NOI is going to increase every single year? So day one, I have an NOI of $72,000. What's going to be year two, year three, year four? So in a real sophisticated model that figures out the IRR, you actually put for every single tenant, tenant by tenant, what the rent is now, what the rent is going to be when the lease renewal, and the rollover. And it calculates literally over the next 10 years exactly what the projected NOI is. Expenses will go up, expenses will go down, this percent, that percent. From the level we're talking about in the calculator, which most people need, is just like back in the envelope. Give me a range, what it'll work for. That's the only other question. Over here, this is actually part of a very sophisticated calculation, so that part was actually written out. So the first section, that's the first section. The second section is the return details. So it shows in the initial investment is $300,000. In year one is $72,000 in NOI. The mortgage payment was $42,967. The profit is $30,000. So this is the example. We had a cash-on-cash return of 10%. Year 2, the 2% says, let's increase 2% where the net operating income is going to go up by 2%. And it brings you a net operating income of $74,000. Same payment to the mortgage. So now the profit, the net operating income, net operating cash flow after the debt service is $31,000 instead of $30,000. The next year it goes the same thing, and it keeps increasing slowly every single year. Another very important point to realize is when you get a cash-on-cash return, that's cash in, cash out. I put in $300,000. I took back $30,000. That's 10%. Don't forget, we went through amortization. In the first year, that $30,000 payment, that $30,000 payment is not there just to take principal. It's just to take interest. I mean, it's also paying down part of the loan. And if it's paying down part of the loan, if it works, I think that 1 second, I'm noticing this potential mistake here. Oops, that's 30,000. There's a little bit of a mistake here that someone made a mistake on one number here. But in the general case, 30%, a good hand, all the disclaimers built in. But it's a 30%, it's $30,000 typically including principal and interest. And if it's including principal and interest, then what happens is that you also pay down some of your balance of the loan. And if you pay back some of the loan, even though you're not getting that money today in my pocket, I'm not getting the cash today, but when you eventually sell the building, you're not going to have to pay back $750,000 to the bank. Your balance is going to be less at that time. That extra money, I'm able to take off the table later. That, again, calculates towards the IRR. It's an actual return I'm getting on the property overall. It will show up in these numbers here. The mistake on this page, just so you realize, is that the mistake on the page is that if the interest rate is 4%, and you're borrowing $750,000, 4% on $750,000 is working out to $30,000. The payments on that is going to work out to $30,000. So the payments. Oh, I'm sorry. I made a mistake here. Okay, go back. I apologize. 30,000. Focus on the wrong number. Let's go back a drop. Sorry. Debt service is $42,000. In the debt service, $30,000 is interest, $12,000 is paying down the loan. So even though I'm not taking it today, when I sell the building later, I'll be able to get that difference later on. I'm sorry, we're good here. Now, so now you go down to the next level. The next level is just pulling down the total returns. I made $30,000 year 1 for a total return of $30,000. Year 2, I took $31,000 dollars plus the 30 from the year before is $61,000. 32. The next year is 32. Pulls it down to 94. Comes to year number 5. In year number 5, I sold the building. What did I sell the building for? The projected NOI at the end of year 5, which is the beginning of year 6, works out to $80,561. At $80,561 divided by a 6% cap rate, that's the cap rate assumption we made in the beginning, gives me a sale price of $1,342,000 and change. The closing cost for that is $40,000 because we guesstimated 3% in closing costs. So therefore, if I have expenses of that of $40,000 plus another expense is I have to pay off the loan, what's left over? $624,000 is left over at that time. It is $624,000. $300,000 is, you could call it return of capital, but still I'm getting $624,000 that day, plus probably whatever the extra cash flow was, that $36,000 that year is throwing off. In total, I'm taking $660,000 for that year. In total, for the life of the investment, I took $788,000. So if you invest $300,000 year 1, and 5 years later, in total, you took out $788,000, what does it work out to your average return? Does it work out to? That's the calculation. Calculates it works out to the 24.16%. If I put it first $300,000 day 1, I would have taken out $24,000 every 24% every year. That's the same equivalent. So here's the deal. If I was selling this investment to someone, instead of a great investment for you. And again, if you're licensed to sell and promote investments, it's securities law. But if I was describing the investment, I say factually, based on projections, they're projecting 10% cash on cash return, and over the life of the loan, the life of the investment. And this investment, we plan on keeping it for holding it. The holding period is for 5 years. It will return an average return, an IRR of 24%. So if someone is happy with earning 24% return for the life of their investment, they're going to come for this. If they're not, they're not. The cash on cash return is secondary. Some people have to, it's a minimum cash on cash they must make, but the main thing is here. This investment will throw off 24%. And that's how this works on the IRR. Continuing on, section 3, page 14. The view of the buyer. There's a difference in how a buyer and a lender views the property. A lender is renting out their money. More on the lender view later. But renting out the money that's the business that they're in. They collect money. Depositors walk into the bank. They deposit money into the bank. If they deposit money into the bank, they're expecting an interest rate on their money. You have a rate when you go to the bank. What rate are they paying you? You deposit. The bank, in order to pay, they have to take their money and rent it out to you, owner of a building, owner of a business, owner of a home. And you're going to pay the bank an interest rate of 4%. They're going to take that 4%, cover their overhead, and use 1% of it to pay the depositors they have to have. They want to be in the business of renting money. Here's your money, paying back monthly, don't give me any headaches. They do all the underwriting to ensure there's a very little, minimal chance that there's going to be any issues. So logically, someone could come to a bank and say, listen, I have a $100 million deal. I'm only borrowing $5 million. It's the safest deal in the world. Why do you care if I'm late? I pay you extra. You make money off me. I have nothing to risk, and I make payments to you. And I pay penalties. The answer is because I'm not in the business of making money. I'll foreclose, I'll buy it, I'll sell it. I'm renting money. I need to keep it simple. My business is set up, my bank is set up, and I have regulars driving me crazy. And what I'm looking for from you is to lend me the money, is to borrow the money, pay it back when you promise. And when the loan matures, pay back the balance, and life goes on. That's what I'm looking for. I rent out money. The buyer looks at a lot of other things as well. Because he looks at price per door, the room, a foot, and cap rates. Because even though a lender, at the end of the day, is protecting, he's going to be protected by if the building's worth more than my loan and everything is fine. But down to the last iota doesn't make a difference. If someone bought this building for $100,000 a door or $200,000 a door versus $199 a door, that's not affecting the loan. It's covered. But the owner, everything makes a difference because every dollar affects the next line. It's cash and cash return. How much I get on the resale. How much will the value grow over time? How much value can be placed on the risk I'm taking? These are concerns that go to a buyer. A buyer is buying a property as an entrepreneur. He's taking a risk. He knows he's going in. You saw that page. You can make 24%. What happens if rates go up? You can't get a 6 cap. You can only sell it for a 7 cap. IR just went down to 20% or 18%. You play with those numbers. What happens if I don't get rent growth of 2% to my NOI every year? It stays flat. What happens if it goes backwards for 1 year? So very good, it's good, but 1 year, I don't make any money. That changes the whole return down to what number? So they have risk and reward. So they could afford to deal with different scenarios because they have certain upsides. The bank has no upside. The best case for the bank is they make the 4% interest rate. The worst case is they lose all the money. So that's why they have to look at things differently while they're going into things. Section 3, page 15. Types of lenders. The lines have been blurred as far as a real estate owner is concerned when it comes to commercial and savings banks. There are officially certain banks are commercial banks, and other banks are called savings and loans. I believe that a lot of it has to do with the regulation, and it's probably behind the scenes how they operate differently. As far as a borrower is concerned, he's borrowing money. He's borrowing money from a bank. It doesn't make a difference to him. It's a commercial bank or savings and loan. It's a bank. What a bank means to him is that there's a live person, the other side of the table, that has the ability to make decisions. And if that person can't make decisions, they have a boss that can. Now, people just want the comfort of that. The best loan you could possibly take, in my opinion, is you could take a loan from a bank. If you could get the same rate from a bank and any other possible financial institution, the best is a bank. The reason is there's someone to talk to. You have a problem, they can modify the loan docs, they can do something, you can work with somebody. It's the best to be able to work with someone under those circumstances. Because if you're in real estate, you always have movement going on in your property. You might get offers to sell it. You might have to refinance it. You want to put work in. Tenants leave. You can restructure it. These things happen on a loan. You want someone to be able to talk to during the life of this loan to deal with. But many times, because they're regulated, there are many instances where banks have a box. They can make a lot of decisions within the documents, but they can't go above 75%, let's say. They can't go below. They can't lend you more. They can't do a debt service coverage ratio below 120. They can't lend more to one borrower of a certain dollar amount. They could have certain restrictions that they have from the regulations. So it might not work for you on every deal. So that's where, but the benefit is if you could work with them, they're the best. The second best is life insurance companies. Now people say life insurance companies are similar to banks. There's a live person, there's a life insurance company. There's New York Life. They allocate a segment of their money that they sell in life insurance policies, and they lend on real estate. I say it's also a very good person to borrow from. The reason why I'm not using that as an example is because very few people qualify and very few people borrow money from life companies. So I want to put something in perspective that comes as a major shock to most people in real estate. You see companies that have these big names. You see they do big deals. So I would ask you, what do you think the average loan amount is for the largest company in the industry? What do you think the average loan amount is on commercial real estate? Most people say numbers in the tens of millions of dollars to be the average size loan. The average loan in America is approximately $8 million. It means the average value, average purchase is somewhere between $10 and $12 million. That's it. So when people think, oh, I'm a small guy, I only have a deal of $8 million. No, you're pretty big. You're above the average. Now, the truth is also, if you took out the top 10, 15, 20 deals that really moves the needle, the average loan in most companies is somewhere between $4 to $5 million. That's it. The industry, if you do everything, it's $8 million. But most people are not financing billion-dollar deals. If you take those deals out, or a $3 billion portfolio, you take those out of the overall average, the average drops drastically. So life insurance companies are typically the ones lending on the large deals also. And the reason is, and the lingo is, there's an expression in business, moving the needle. If I'm trying to do $1 billion worth of business, I can't do it on $500,000 loans. You know how many loans I have to do to move the needle and make a dent in my production? If I did a $100 million loan in a clip, I do 10 loans, I'm done. Every loan is 10% of my business. I do $50 million, 20 loans I can do to move the needle. A life insurance company has so much money they want to put out. In order for them to move the needle, and they're not doing a small loan. They're doing typically a larger deal. Also, they only want to lend to the creme de la creme, the cream of the crop. They want to make sure they're being very conservative because they can't afford to take risk. They know they're going to have to make a payout on insurance. They can't afford to go backwards. They don't mind growing slowly. They can never go backwards. So they typically only want to lend 65%. They typically want to lend to someone who has pristine, they have a professional office, professional setting. Who could afford to have a professional office, professional setting, and all that? Someone who either owns a lot of small properties or a few larger properties, either or. But typically, the person who owns a lot of smaller properties doesn't have the quality of the property that makes sense. The entrepreneurs own a lot of real estate. You look at the big buildings that you see in every major city. When they're looking for a loan, a 65% loan, a conservative loan, life insurance companies are the ones making the loans to those properties. Will they go down to $20 million? Like I call up some life insurance companies and say, yeah, we'll do loans, has to be above $25 million. So it's not huge, $25 million, but if you look at the average, think about the rest, in a typical place throughout the country, a building could be worth $1 million, $2 million. You know how many of those buildings there are? Thousands and thousands and thousands. How many buildings are office buildings? Large apartment complexes, not that many. And therefore, that's why maybe it's a better option, but a practical option can be for most people are going to be getting a bank deal. The third thing is Fannie Mae and Freddie Mac. It's agency. It's called agency loans. Now, is it owned by the government, not owned by the government, implied, not implied? Nobody really knows the answer. But what is relevant to you is that the benefit to you is that there's a cookie cutter box. And if you could fit into that box, there's no one to talk to after you close, for the most part. If you could fit into their box, they will give you probably the best terms on any loan. So today, they have the best rates for 10-year money today. They're going to 80% financing. They're willing to give you potentially 1 year that you don't have to pay down any principal. It's called interest only. There'll be a lot more flexibility because they have a box that they're able to, they securitize it. You're not dealing with a bank that has different sets of regulators. Now, this is an important point to realize regulation. Most owners of banks look, it's crazy. I meet a banker, he tells me it's nuts. The government comes in and tells me I can't lend more than 75%. I can't give interest only. Every loan has to have amortization, make sure there's a pay down. That's what they tell me all the time. Yet, along comes Fannie Mae, government owned, sponsored, or something related. They're lending 80%. They're able to do interest only. How can I compete? And their answer is, there's no real answer to it. I got the answer now, but no one has an answer. It doesn't make sense. It looks like unfair competition. Put regulation on our competitors. Let the government loan go out there. Also, it doesn't make sense. The government created Fannie Mae and Freddie Mac. They created primarily to give liquidity for housing. So what's housing? People who buy houses. So they're the ones who provide the most loans or buy loans from banks from 1 to 4 family homes. plus provide liquidity, provide money for apartment buildings. So if I'm a developer, if I knew I could get a mortgage when I finish building this apartment complex, I'll build it because I get my money back and I can do the next project. So to help people that can't afford to buy but want to rent, so Fannie Mae and Freddie Mac are there also. But their goal is to help a problem. Everyone in business, if tomorrow morning you open up a store and everyone else around you is charging $10 for a certain item, you're not going to open up your store and charge $5. You're going to try to charge $10 first, maybe $9.50, $900. Try to get enough competition to get your business. But the minute you get your business, you get a lot of flow in business. You can raise your pricing. And you could play with the pricing. Fannie Mae has no competition. They're coming in cheaper than every bank, giving more proceeds. Like, to what extent? Like, the whole thing is crazy. So you have regulation on one side, which is not letting the banks do the same type of business, telling them to slow down on multifamily lending today, and how the regulations are, and letting Fannie Mae go totally crazy. On the flip side of the coin, you also have Fannie Mae's doing loans. It's like, why are they in certain markets even? If there's enough liquidity in some major markets, Fannie Mae should lend there and say, we don't have to be there. We're only going to be in places we're going to have to show up. So I don't have all the answers, but I have two answers that seem to make sense to a certain extent. The one is why they're in any market at the end of the day is because there's someone running Fannie Mae today, and the most profitable part of their business is lending money in commercial real estate. So they're trying to push whatever they can. But as far as the regulation is concerned, here's the key part of the regulation. There are a lot of agencies in the government and to regulate things. The agency that's regulating the banks is not from a real estate perspective. It's the agency that's insuring the FDIC, Federal Deposit Insurance. When you put money into the bank, you're safe. And you say to yourself, if the bank goes bankrupt, if there's a problem, the government guarantee me the money. The insurance agency, for lack of a better word, that's guaranteeing the money, that's the one that's giving regulation to the bank. They're going into the bank and saying, it's fine if Fannie Mae's doing it. And you might be right, the building's worth $10 million, and an $8 million loan is safe. But you know something? I'm guaranteeing $10 billion worth of deposits in this institution, and I want to play it a little safer. So it's not the same regulation. To a layman, it's the same regulation. It's not. The people that are regulating Fannie and Freddie are regulating, do you have losses? Oh, you don't have losses? So you could stretch the envelope a little bit. You go further. It's a different hat that's deciding. For the banks, it's a hat it's discussing on the insurance part of it. They want a bank to diversify. It's not putting pressure, don't make multifamily loans. They're telling the bank, listen, you have $10 billion worth of deposits. You're doing $10 billion worth of loans, diversify. Only put 30% in commercial real estate, 20% in apartments, 40% here. Business loans, all different types of loans, however you structure it. So on one hand, you could say, but at the end of the day, they work for the same government, but that's where they're coming from, two different angles. And you understand that way, it starts to make a little more, at least you could logically begin to understand how it's possible that there's there's regulation, yet they're sending two different messages to two different lending types of institutions. Wall Street is, the way we know it today, is Goldman Sachs. It used to be like Lehman Brothers, and there used to be Bear Stearns, Wall Street houses, that they themselves are money centers. They're not lending any money. What they're doing is they're just packaging money and selling it off. And they're the cause, for good and for bad, of the crisis, the last crisis. And people are nervous today. There's going to be another bubble, part of it from the banking side. Not really nervous today because banks have the regulation in place. They're more streamlined and they're more prudent in how they're lending. They have underwriting stronger procedures. But what Wall Street basically is an institution that they're a glorious mortgage broker. I'm a mortgage broker. I have no risk in the transaction. I clearly make an introduction from the borrower to the lender. The two of them ultimately meet. If they agree to do the terms, I facilitate the process, and they close, and everyone's happy. I got paid a fee at the closing to do my business, and I go home. Wall Street does one step different. Wall Street would go out, they take their own $100 million. They lend it out, $5 million here, $3 million here, $12 million here, $8 million here. They lend out $100 million worth of business. They have it on the books. They took an actual risk. Then they package it and try to find someone to buy it. That's that difference. I introduce borrower and lender, and they meet. If a deal closes, I get paid. If it doesn't close, I don't get paid. Wall Street actually lends the money. So what they're taking a risk is, what happens if they lend out money at 4% interest rate, expecting to find someone who's happy at 4% interest rate, and they could sell it off to them and say, give me back my $100 million and some sort of fee, and I'll give you the rights to collect 4% going forward. What happens if interest rates go to 5%? Now they close the loan, and now people say, I don't want just a 4% return on real estate, I want a 5% return. They can't collect $100 million. They're going to have to take a loss. They're going to say, okay, fine. For the next 10 years, a 10-year note, you're losing 1% a year, fine. Only give me $90 million. And they lost $10 million. They're taking a risk when they do these loans. They price it in, of course. They price it in everything inside the risk, but they take a risk. So what Wall Street did is they figured out a system. It was called CMBS, Commercial Mortgage-Backed Securities, where they built a commercial mortgage-backed security system, a whole process we went through previously, where they arranged for life companies, hard money lenders, APs, BPs, put it all together, and they made one loan on one end of it, packaged it to 100 or 30 or 50 different people on the other side. And each people bid. They created a whole competition. People bid on every single slug of that $100 million business. And that's how they made the loans. What the worst part for borrowers to go to Wall Street. So here's where it's good, here's where it's bad. It's good because they probably gave you the best deals in the data market. Because as long as they found someone out there willing to make this loan, there's no regulation involved. They made the best loans. The problem is, there was no one to talk to. A loan closed, there's a manager who, if he made the wrong decision, could get sued by the investors. So he didn't want to give answers. And you have 100 different people. There's no one how to say. So that was the negative to the Wall Street loans. But I'll tell you where the problem comes out negative, where it's really a problem. I have a shopping center. I see news that Radio Shack is my tenants. I get news they're about to go bankrupt. The guy from Radio Shack walks in and says, by the way, before I go bankrupt, if you want, I'll give you back my lease. If you let me out of a 10-year lease, let me out of it. I tell him, no problem. I'd love to let him out of the lease. I have a vacant store now, not caught up in whole bankruptcy, and I could rent out the store, lease out the store to somebody else. So what would happen? It makes a lot of business sense. Even if I got less rent, if you were the owner, that's what you'd want to do. If you're the lender, that's what you'd want to do. Pick up the phone to Wall Street. Sorry, I can't get approval. Who's he talking to? What if they don't end up going bankrupt? Then I gave you permission to make this a weaker center. And later on, if something negative comes from it, they're going to blame me. So you don't get permission. So you're stuck now at the building. You can't rent out the space. Radio Shack goes bankrupt. It goes dark. Other tenants want to leave the center also. The whole thing falls apart. That's what happened. A lot of deals that fell apart because no one to talk to. Now you understand the other way around why banks are the best. There's someone to talk to on the other side of the equation, on the other side of the table, that every single move you want to make. Hard money lenders and bridge loans, they are private individual people typically that have extra money. And they say, I don't want to invest in real estate and have to deal with owning a property and all the issues that go along with owning a property. And I don't want to only make 6%, and I don't want to lock my money for 10 years, and I don't want to do all those things. Simply put, you're buying a building today, a vacant building, no one's giving you a loan. The term bridge loan is literally a bridge. I have a building here today. It's not ready to go to a bank, but in a year, it'll be ready to go to a bank. I need a loan to bridge me from here to there. So officially, a construction loan, okay, should also be a bridge loan. A bridge is a vacant building, a vacant piece of land, with a loan until you get a stabilized loan at the end of the day. Today, the word bridge loans became synonymous with hard money loans, expensive money. That's what it came with. But it's not really true. Because sometimes I go to a bank, if I have strong credit, and I have a building that's half rented, and it has a good story, I could find a bank sometimes to lend me money at competitive pricing as a bridge loan. But the lingo we're discussing here, for the purpose here, is called a hard money loan, which means typically in the industry, there's a building that no bank will finance today. It's a vacant building. I'm an entrepreneur. I bought it. I paid $10 million for it because I believe I'll pay $10 million. I'll put $3-4 million into the building, including leasing commissions and tenant improvements and fixing it up, making it nice. I'll rent it out. I'll bring my NOI to a point where the building's worth $20 million. So I think I'm getting myself a great deal. I'll be in for $14 million. It's risky because if it takes me 18 months instead of 12 months, if I get the rent a little less instead of a little more, I'm taking a risk, but it's a good deal. Banks can't finance it because regulation. How they finance it doesn't fit the box. The box requires certain percent occupancy, certain debt service coverage. It requires a lot of different things. Also, if you're buying a building like this, you want to close fast and move. You don't want to deal every time you need money, calling the bank. It's a problem. It's a deal. If a guy walks into a hard money lender and says, I'll tell you what, I'm buying it for $10 million, total cost is 14, the total cost in the deal is $14 million. I want to be very conservative. I'll give you 60% of your money. I'll charge you 12% interest. you're making 30–40% IRR by the time this deal is all said and done. So a hard money loan is another word for it that I call it. It's called cheap equity. If I took a partner for this, I'm promising a partner a much higher return, I'm giving you a piece of the deal. Maybe I can get away with not giving away as much to my other partners because I have 60% of the money coming from you. So is 12% expensive? Yes, but it's cheap equity. So now he doesn't have to raise $14 million from friends and family. He could only have to raise $6 million or $4 million or $7 million or $8 million. That's the number he has to raise, whatever he agrees with the hard money lender. The view of the lender. The banks are essentially renting out their money. How easy can the borrower make his monthly payments? They use conservative underwriting. So if there's ever an option to say, last year's expenses were $100,000, but 2 years ago was $110,000. I'm going with the more conservative one, I'm paying $110,000. I believe that it costs $200 a room to heat a building. But you already put down $220 a room, I'm using the higher one. They're always going to use the higher of everything. Debt service coverage ratio. So even after they have all said and done, and they beat up your numbers, and they just agree to a $72,000 NOI, I want to make sure that you have enough coverage. Aside from paying the mortgage, you have a buffer above that for an additional rainy day and to be motivated to run this building. Plus, that helps me I know there's a good chance on the rent or covered. Renting out the money shows me that you very easily could make the payments on a rental payment. But how do I know that all said and done, come back to refinance later, you could pay me back the balance? Very nice, you could afford the monthly payment. Maybe the building's not worth the money later on. So the example would be is that what happens if someone tomorrow morning had a loan, 4 years left on a loan from a very strong tenant? You know that that tenant's going to be there for 4 years. You could trust the cash flow for the next 4 years. So I'll collect $200,000 a year in income, and let's say NOI from this tenant. I can afford to borrow whatever the numbers I can afford to borrow, $2 million on this building, $2.5 million. What's going to be in year number 5? There's no tenant there, it might not be worth it. So the bank orders an appraiser to tell it that you could lend that person the money because this building is worth that amount of money, knowing the tenant's going to leave. The building is worth $2 million today, so you could lend them, be comfortable with $1.5 million. You're covered from an LTV perspective, because even if the tenant left, the building will be worth $2 million. If the tenant stayed, extended the lease, it's worth $3 million or $4 million. You could count on the loan to value combined with he has enough money to make the payments. So a lender has 2 exit strategies. They can sell the building, and they can pay the payments anyway. What if we have to foreclose? That's the question that ultimately is asked. And if the answers above this line were good, then they're fine. I have to foreclose, I'm comfortable. I'm only lending $1.5 million on this building. Go with the example, back to our normal example. I'm lending $750,000. If I have to foreclose, I know I could sell it for $1 million. Now, what's really not right about that is that if I have to foreclose, I can't sell it for $1 million. The reason why you're foreclosing is because something went wrong. If everything is going great, why didn't the owner keep making payments? So in a 1 to 4 family house, and potentially there's a divorce going on, it's nothing to do with the financial situation too. But here's an income. The income is owned by a property, and the LLC owns it. And it's probably has a single purpose entity owns it. The LLC does nothing else but own this property. So the only issue is it's probably a problem with the property. If there's a problem with the property, then you're not going to be able to sell it for that. But that's why they want all these buffers. Is there enough of a buffer that it won't be worth $1 million? It'll be worth $900,000. Worth $800,000. We sell it for $800,000. I get my $750,000, and you, the owner, gets $50,000. You lost $200,000. You came in knowing you're taking a risk. I didn't come to take a risk. I'm taking a stupid, measly 4% interest rate. What are you bothering me for? That's what I have to foreclose. That's the way they're looking at it. The whole thing is looking at it. So we had a lender that did business, and he would tell me, he says, I do a loan. I said, how are you willing to stretch the dollars? You're not nervous? He says, Ira, let me tell you how I view it. Under the hammer of the bankruptcy judge, how much is this building going to be worth? And I'll lend you 90% of that number. So don't tell me it's worth $1 million. I know if we have to sell this on a fire sale tomorrow morning, we'll go for $8 million. Instead of $10 million, we'll go for $8 million. No, I'll give you 90% of that. Yes, regulation now makes me whatever that you have, like you tell me, he gave his loans, I'm willing to lend you this money. Find an appraiser to prove it out and give you the value you need to 75% loan to value. But he has no number. He couldn't care less about the market. I'm a bank, so I can't make my own decisions. But that's where he's really right. Because what's something worth? When there's a problem, what can I sell last minute as a problem what is it going to go down to, and then give someone a discount, 10% off that, you'll sell it very fast. Recourse. This is what everyone tries to avoid, is having loan personally guaranteed. Multifamily loans today do not have a personal guarantee, for the most part. So if something goes sour, someone can walk over to the bank and say, bank, here's the keys back. I did honestly what I was supposed to do on this property. I'm sorry, there's a problem. Take it back. On a commercial building, for the most part, business loans, your home, it's personally guaranteed. That means if the bank, you give back the keys, they sell it, they take a loss, they can come after you personally. In certain states, they have the right to come to you first. They don't have to even go through the foreclosure. You have money in the bank, freeze that money, you sign recourse and take it. Obviously, there's courts and fighting and all that goes on, but the concept is recourse. Recourse, the reason why you should not be signing recourse and people don't sign recourse is because recourse could set you backwards. And everything we showed you here today, in all these courses we showed you, I'm buying a building for $1 million. I'm putting up $300,000. How much am I going to make? Worst case scenario, make nothing. Worst case scenario, building is really a scam. It's only worth $750. I have to sell it, I lose my money. But at least you know I took $300,000. I risked $300,000. What happens if you find that no, you didn't risk $300,000? You really risked more because you signed the personal guarantee, and the bank can't even sell it for $650. Not only do you lose your $300, they're not going to do it for $100 more. You never planned for that. So that's why people don't sign recourse and don't want to sign recourse. There are people who wouldn't do a deal if there is recourse. There are people who, if you have to sign recourse, I'll take in a partner, give him part of my deal, my profits, and go ahead not to sign recourse. And one thing I could tell you from most people that go into real estate, by a high percent, never went to college. And by a high percent, they're entrepreneurs. And they said, they'll make the money, they'll figure it out. And the one thing that college trains you in, different than being an entrepreneur, is an entrepreneur focuses on how much money could I make first, and then second, they focus on the losses. And the key thing is to go the opposite, risk versus reward. You want to focus on your loss first. You want to focus on the return of your investment. ROI means return on investment, that's the lingo. But really, the joke is return of your investment. First show me that I'm for sure getting my money back. Then I'll talk to you about how much I can make on my money. And if you watch on Shark Tank, every single way they ask the questions, their whole focus is on, first show my money's safe. After my money's safe, then I'll worry about 2, 3, and 4. And most entrepreneurs make the mistake because they go the other way. They fight before they even start. What do you mean? If it's going to make $80 million, you should make this much, I should only make this. Focus the other way. Focus more on the downside before that upside. You meet very few people that are making a ton of money and complaining that they made a bad deal what their partnership splits out with their partners. You meet a lot more people who lost money and have regrets on the money they went ahead and lost. So recourse. Banks are regulated and therefore require personal guarantees from borrowers. However, in order to compete with other lenders, banks generally give non-recourse loans on multifamily properties because they're deemed less risky than commercial properties such as office space or retail. Wall Street lenders will lend non-recourse, even for strictly commercial properties. This can be explained by the fact that Wall Street lenders will only lend if a deal is so sound and secure that they can afford to take the risk of non-recourse. This is the key piece here. When somebody, what Wall Street did, the genius of what they figured out, is they figured out how does Microsoft borrow money? How does Apple borrow money? How does every company borrow money? They borrow money, they float a bond, and they find people who are willing to lend that company money. How do they lend that company money? A 10-year bond, typically. Apple wants to borrow $1 billion. They go out there and they sell in a security. They find someone, I'll lend them $50 million, I'll lend them $100 million, $20 million. They find all different funds and people. Together, there's $1 billion that's lent to them at a rate 2%. Apple doesn't pay amortization. They pay every year interest only. At the end of the 10 years, they pay back the $1 billion. That's how it works. What Wall Street did, there's no personal guarantee to the owner of any of these companies. It's to the business. If you need a personal guarantee, it gets complicated. Because that means it's not a safe enough loan they can structure. It means you're nervous about something. You could say, no, I'm not nervous, I want extra security. It gets complicated. You have to underwrite a new person, it gets very complicated. So Wall Street does a loan. That's what I love about the Wall Street loans. And on the larger deals, a lot of them are Wall Street. Because there's no regulation in size. There's no regulation in structure. And as long as they believe they can find people to buy the loan after they close it, they'll make the loan. Buying it is all about logic. So where I have a tenant coming due in 4 years from now on a wall. Let's have a tenant coming due in 4 years from now. I have a shopping center. The grocery store is coming due in 4 years. They're paying $8 a foot because the lease is 30 years old. The market today is $16 a foot. If I own the building, I have patience. I'll wait to 4 years because every year the market's getting better. This grocery store is doing amazing. I'll re-sign the lease in 4 years from now. Wall Street's going to tell me, I'm sorry, I can't do the loan. They're coming due in 4 years from now. In order for them to do the loan, I'm going to have to reserve a lot of money. They're going to say, you want me to do the loan? No problem. But we have to assume when this loan comes due, like I said in the previous course, only a 65% chance they can renew. 35% chance they're not going to renew. What will it cost if they renew to fit out space? What will it cost if they leave to find another tenant? How much downtime could you have if they leave? 6 months? You can be short on the mortgage payment for those 6 months. You have to leave money in escrow. So if I have enough money in cash when I'm buying this deal, I'm fine, I can do it. On the other hand, I walk into a local bank. The local bank says, no problem, I'll lend you the money, give me a personal guarantee. If there's a problem, I'll knock on your door and I'll make those loans happen. So the recourse component triggers why Wall Street is not bound by regulation. It's all logic. So if you logically could show me that I should be comfortable, and you put enough money away based on all numbers and projections, then I'm fine. A bank could listen to a story and just, oh, no problem, I'll trust you. And as long as they actually trust you, your financials are fine, they're fine. The one thing that became the next thing to recourse that people do is what they do, a master lease that solves some of these problems. So someone would walk into a bank and say, listen, I know that the ShopRite is coming due in 4 years from now. I'll tell you what I'll do. I'll give you a master lease for 10 years. So if ShopRite comes due, I'm personally on the hook for a lease. So I'm not guaranteeing the loan. I'm guaranteeing, so to speak, the rent. That you'll collect this rent like a mortgage rent, like a debt service guarantee. But it's a master lease to this spot. So why would a borrower do it then in that case? Because what's his liability? He knows what his liability is. His liability is there's 100,000 square feet times $8 is $800,000. I'm liable for 6 years, extending it from today as if you have a 10-year master lease. There's 4 years left to that lease. I'm giving you 6 more years of my guarantee, then I'll make those payments. How does he get off the hook? He rents it out to another store. It's paying at least $8 a foot for at least 6 years. Then he's off the hook. But he says to himself, worst case scenario, where are rents going to? Rents are going to get cut in half? Okay. I'll take the money today. I'll only be on the hook for $400,000 a year. And really, he probably has that in profits anyway in the building. He's on the hook, potentially. He's not nervous about the rent. The fear is, and there's a very important point to know in today's market, we're in a rising rate environment. Interest rates are going up. We're in a rising rate environment comes with rising cap rates. And the values could go down. So the owner says, listen, I know in this neighborhood, I will always collect. Think about an apartment. You own an apartment building. The rents in the building are $2,000 a month. You're confident the rents are not going down. And if they do, $1,800. You're not nervous to sign a master lease that if there's a vacant tenant, you'll take over that tenant. Because you know you'll always find the tenant for $2,000, not $1,800. So what do you have to come out of pocket, $200? But how do I know that the real estate's going to be worth $20 million? Maybe income, go on this example, the $72,000 deal. Maybe the cap rate's going to go up at an 8 cap. The building's not worth $1 million anymore. The income's going to be there. We'll have NOI of $72,000, but it's going to be worth $950,000, $900,000, $850,000. I can be in trouble. Income, I'm comfortable. Sometimes banks will say, fine, I'll tell you what. You have short-term leases, a master lease will cover you instead. Sometimes they say, no. This is the actual lease in place. I'm not trusting you. But that's something to get someone comfortable without signing. That's like meeting in the middle between a recourse and signing a master lease. Page 3, section 3, page 18. There's a whole slew of different types of recourses. Between me and you, as far as you're concerned, recourse is recourse. If there's a problem, you're in trouble. And between me and you, when you're in trouble, okay, you're usually not in trouble for the whole loan. So let's call this loan a $750,000. If something goes sour, what's going to happen? The building's not worth $1 million, it's worth $900,000. I probably sold it anyway, and I paid off the bank. What's the chances that the building is going to be worth only $750,000? Very small. And even they want to say it's going to be worth $750,000. But how much? Let's move worse than $750,000. It's going to go down to $650,000, $600,000. Real estate has never dropped, commercial real estate, to my knowledge, ever, cash flowing real estate, more than 30%, 40%. So what's really my risk? Only the top 15% of it. But over time, people care for different things. I'm going to go through this very quickly. Not as relevant, just showing you different terminologies. The most common one is full recourse. You're signing a personal guarantee. That's it. There's a problem, I come after you, that's it. Partial recourse is where they sign a guarantee where I'm responsible for the top 20% of the loan or 20% of the loss, but usually it's the top 20% of the loan. So the bank's basically saying, I'll tell you what, I'm lending you $750. There's a problem, you're only responsible for the first $150,000 of losses. Very good. It's the same thing like being responsible for the whole thing. What's the chance? I'm not going to sell this for $600,000. Same thing. $750, and I'm responsible for 150 of losses. It's like a deductible. Big deal. Same thing. The reason why a borrower wants it sometimes is for his financial statement. When he puts his net worth, he has to do contingent liability. What other liabilities does he have? I could potentially be on the hook, 150, versus writing potentially on the book 750. It might be tough for him to get other loans in other places. He has too much potential liability. But practically speaking, if there's a problem, it's the same thing. Burn-off recourse is recourse where I'm nervous right now that you don't have a tenant. I'm doing recourse for this whole loan. If you end up renewing the lease with a new tenant of creditworthiness, then no problem. I'll change the deal with you, and I'll make it non-recourse. So some people are nervous about recourse, but say, you know something, I'm comfortable signing a lease. Within the next 6 months, a year, 2 years, no problem. Recourse on the loan until I fix that problem. Someone has a loan with environmental issues, I'm fixing it. Recourse, I fixed environmental issues, I'll take away the recourse. Springing recourse is the opposite way. Okay, no problem, it's non-recourse. But if a tenant leaves, a big tenant leaves, it turns to a recourse loan. Or if you do something wrong, it turns into a recourse loan. A walkaway guarantee is a little bit along the lines of springing a little bit and burn off mixed all together. A walkaway guarantee is as follows. Most losses that take place after a problem. Then there's a fight and the building starts deteriorating. And if I'm on the hook, I'm going to try to hold on to this building as long as possible. Maybe the market will come back for me. I want to push off the problems. So sometimes the lender says, I'll tell you what, we'll do a walkaway guarantee. If you deliver what you're supposed to do, you come to me at any time and you say, bank, here's the story. I'm having a problem with building. But the taxes are current, all the bills are current, everything is current, but I know I'm having problems. It's going to fall apart. Here's the keys. And anytime you give me the keys and everything is current, the bank says, no problem, I'll take it over. So you miss your payment 1 month, you don't fight me, instead just give me back the keys and you walk, I'll give you a walkaway guarantee. Just walk away, you have no guarantee. So it depends who you are. Some banks doesn't work for them. But when some sophisticated lenders on Wall Street, different places, structure that in, so what do they really care about? If there's a problem with the building, don't make the building worse. Hand me the keys. I'll try to salvage it. And that's how they try to work things out. So depending on what your risks are, what you think is going on, you'll deal with it. Deficiency guarantees, I think, is the best guarantee you have to sign if a bank would lend you to it. I think it's the worst for the lender, it's the best for you. Deficiency guarantee tells the borrower only has to pay the deficiency of the loss. So the bank can't come to him and say, the building's $750, there's a problem, give me $750. The bank has to actually foreclose, sell the building, see the loss at the end of the day, and then come to me only for that loss. The odds are, sometime between the day there's a problem and the day the guarantee kicks in, either the market came back around, the bank was made whole, or the bank is getting nervous, it's going to get worse and worse. And if you're having problems, you're probably having problems the rest of your life, your guarantee's not worth that much anyway, and the bank would upgrade it to a walkaway guarantee. I'll tell you what, give me the keys back today, and you can walk, and have a nice day, goodbye, and go from there. Debt service coverage ratio. So these next few pages are relatively quick because it's a recap of things we spoke out for a long time with different parts, and it's written out very clearly. Debt service, the money needed to service your debt. That's the yearly principal and interest payment. Debt service coverage ratio, DSCR, allows you to measure how easily or difficultly you can make your mortgage payments. If you need to take every dollar of cash flow and give it to the bank is afraid you'll fall short at some point and not make payments. So they put an added buffer in there. Typically, the buffer is today between 20 and 30%. Your payments, in our case, is $42,000 is the mortgage payment on that deal. 20% is about $8,500. They would only do a loan with you if you have at least $50,000 in NOI. $42,000 to pay them, and in principal and interest, and then you have the 20% left over. it's 25%. You need more, and that's these spreadsheets. You can play with it. How much can you borrow based on the service coverage? Again, the mortgage, the app, the Eastern app has all these calculators built in. Dividing your NOI after the tenant improvement and leasing commissions. So you're dividing your net cash flow by your annual mortgage payments will give you the debt service coverage ratio. It will tell you how much you have available. And if it's above the bank's minimum, great. If it's not, you have a problem. Banks today like to see between 125 and 135 of your debt service. 120 is for a great multifamily. You could still get it in certain cases. The reason why I wrote in the paper here, the 125, is I think that for your own underwriting, you should always try to make a buffer to work for 125. And if it works, it's going to get better by the time you come to a mortgage brokerage or bank for loans. A 130 debt service coverage ratio tells you that your NOI is 1.3 times or 130% of the amount needed for debt. So to keep it round now, is that if my mortgage payment is $100,000 and I need a 130 debt service coverage, I need an NOI of $130,000. So it's $100,000 to the bank, and 30% of that, above that, gives me an NOI of $130,000. In our example, section 2, page 678, section 3, page 678 and 9, debt service coverage would be 1.7, NOI divided by debt service, 1.7. In such an instance, the bank is extremely comfortable lending the money. They have a lot of room for error over there. Disclaimer, reserves, tenant improvement, leasing commissions after debt service coverage affect debt service coverage after the NOI. So you have an NOI of a building of $72,000. The bank has made you put reserves on top of that of $10,000. As far as this conversation is concerned, for debt service coverage ratio, it's on the $62,000, not on the $72,000. Unfortunately, everyone uses the same word, NOI, and they use it interchangeably. But it really means NOI is the NOI of the building, but after the reserve, it's net cash flow. So it gets a little confusing there. But for the most part, in the simple form, most of the banks are doing it. You need a debt service coverage of your net cash flow that's there. Sometimes even banks don't even focus on net cash flow and focus only on the NOI anyway. It's a little bit of a gray area, but that's for what you care about is to get the concept to the point. And in practicality, you'll have an offer on the table. You'll see how the numbers play in. Terms and amortization. So I'm going to end up finishing the book in this session because we went through the other pages in detail. We went through it in previous in much more detail. Terms and amortization. Floating versus fixed rate. At times, your rate can be fixed for life of the term, while other deals have a floating rate where your rate floats a given amount above a given index, i.e. a given amount of basis points above LIBOR. In that case, your rate can change daily or monthly for the life of the term. Now, I'm sure if I had an English major, they can make this paragraph a little more grammatically correct. However, this is the lingo, so I had to blend in the lingo at some level of how people communicate and talk versus if I gave you the way it's written out in English, you go talk to a bank, you'd be talking French to them, and you wouldn't be speaking the same language. Basically, here's the story. A bank makes a loan to you. The bank cannot commit to stay at the same interest rate for 30 years. Because a bank doesn't have people walk into the bank and say, I'm depositing $100 staying to the bank. I'm going to keep it there for 30 years. What's your rate? Oh, you're going to pay me 1.3% for the next 30 years? Done. Take my money, and I don't need to see you for 30 years. All of you have bank accounts. You have a checking account. Probably pays you nothing, but money's going in and out every day. You have a savings account because you have some extra money in your checking account. At least make some interest in it. If you know you're not touching that money for a few months at a clip, you might have a money market account. Well, you might lock into a 3-month CD. A 1-year CD, but that's it. So how does a bank lend money? They have to hedge themselves and do all different types of things to calculate and make sure if rates go up, they're still comfortable. That's why, just like the Wall Street lender can make a loan today, put it together and sell it. They're doing the same thing. They're putting a loan today, at least by the Wall Street lender, once they sell it, it's done. Whoever bought it has to deal with changes in the market. But as a bank changes every single day, the rates that could change on them. So they hedge themselves. That's why they don't charge 1.5% to borrow money. And even though they're only paying 1% to the depositors, because they have to have a margin of error to do things with the money in case there's a problem, plus their expenses. But let's say they agree they're going to give you a loan for 5 years, 7 years, 10 years. The typical deal is that sometimes they're going to come in and say, listen, I'm not going to lock the rate. Someone comes to the bank and says, listen here, I want a very short-term loan. I want a 1-year loan from you. A construction loan is the best example. You can't lock the rate on a construction loan. Every month I'm taking more money, the loan, everything changes on a monthly basis. So the bank says, I'm going to give you a floating rate loan. I'm going to commit to stay with you for 5 years. I'm going to commit to stay with you for 3 years, for 2 years. I'm going to stay with you. You could keep my money for that amount of time, then you have to pay me back the balance at the end of that. But during this time, am I going to lock the rate? Or am I going to float the rate? If I'm going to lock the rate, I'm going to lock the rate at, we'll figure out my cost of money is. I'll figure out a profit margin I want above that, a spread I want above that, and that's the rate. If you skip to page, you skip to page 23, same section, and you want to see it live, is again on the app. This is one of the features that people look at on a daily basis. It shows you the rates live. This is showing you what the rates are. So I'll give you the example of how this works. Prime is set by the government. That's what the Feds set prime. They actually set the overnight lending rates, which if one bank wants to lend money to another bank, what's the rate? And then prime is set as an index. It's usually 3% higher. So today prime is actually 4%. That's the last time they raised the rates. They brought it up to 4. But prime is how all credit card loans are based on, all short-term loans, home equity loans. Your loan is prime plus 1. What's your rate? 5%. That's a floating rate. If the Feds raise the prime to 4.25, you got a phone call. Your rates just went up. So when the Feds raised the rates, everyone had a credit card debt. The rates went up. Everyone had home equity loans. The rates went up because it was all based on prime. 30-day LIBOR is the London interbank changing. It's the rate. I don't know the exact acronym for the whole word. It's irrelevant to know. It's known only as LIBOR. It's not like the SCR is also known as debt service coverage. You're never going to hear someone say anything else but LIBOR. So you can call it LIBOR. LIBOR is basically what the banks, so it's better than the Feds we have here. What are actually, they survey, there's a whole investigation in it, but what works is that what a bank in London is lending money bank to each other, they found out what would you charge overnight? What would you charge overnight rates? They took the average and that's what the rates are. So it changes. It's 30 days at a clip. I want to borrow money from you for 30 days at a clip. What's the rate? A few months ago, this was 0.24, 0.18. This took the biggest jump because the short-term rates jumped very high in the last few months since Trump was elected as president. So the 30-day LIBOR. So if I was getting a loan, most loans from banks today are based on LIBOR for commercial real estate. So a bank would say, here's a story. I need to see a 3% profit margin. Your rate is 3.78% now for the next 30 days. 30 days from today, what's LIBOR at? 0.84. Your rates go for the next month is 1/12 of 3.84. It goes down, goes up and down, and moves there. So who's taking the risk? The borrower. The bank is not taking the risk. They're constant. They're in there straight. They're getting their profit margin every single month, whatever they need to run the business. The banks would love to give everyone a floating rate business. Borrowers hate floating rate. They want to lock in their rate. But even if banks do give floating rate, what if the rates jump to 5%? Plus 3 is 8. It's a problem. So the way banks deal with that is if they give you a floating rate deal, they make you buy like a collar or a cap. You can go to some institution, will sell you, but in case, because they did a stress test, a 130 coverage. They made the loan based on a 130 coverage. But that only works, you can only borrow the $10 million I lent you, only as long as the interest rate is less than 4.12%. So I tell you, buy an insurance policy. I'll do this loan for you. You think it's staying in this range under 4? It's going to hover around 3.5%, 4%. But I can't take a risk. It goes to 4.12. So they can buy an insurance policy, so to speak, from a company that'll sell insurance policy. But if the rate goes above 4.1%, that insurance company will make the difference in payments out to the lender for the life of the loan. Typically, floating rates are 1 or 2 year loans. But someone who wants a loan for longer, both sides want you to just lock it in and deal with it. 5-year treasury is typically like a 5-year loan. So a bank would either say your rate is 4%, that's it, or they'll tell you, no, your rate is 2%, 200 basis points, 2% above, which means 1.86 plus 2 equals 3.86. So your rate is going to be, your rate will float, meaning from the day I give you the offer, assuming we close today is the lingo of my business. Assuming you close today, your rate would be 3.86. However, the rate doesn't get fixed and lock in until the day we close or a few days before we rate lock. That's the time they actually go out and buy the treasury bill, lock the rate, they put up money for it, and that becomes your rate for the next 5 years. That's what I was giving in previous sessions, giving an example. I'm talking about interest rates, where rates go up and rates go down and treasuries and all these things change, is that what changes in the treasury bill is that What happens if someone bought a loan, went to contract and bought a building, and he ran his numbers assuming a rate of 3.86, and he knows it'll close in 60 days. And also the rates spike up. The 5-year T-bill is not 1.86. The 5-year T-bill is 2.1, 2.5. He ran all his numbers assuming he's getting a rate of 3.8. Now he's getting a rate of 4.5. The IRRs aren't the same. The cash on cash is not the same. The banks can't lend him as much. He has to come with more equity. It skews everything for him. In that case, he runs into problems. So that's that risk that gets taken. But that risk is only typically for 30, 60, 90 days. So people could say, I don't think things are changing drastically in that time, or no. They're hedging themselves for that possibility. Look at the 10-year T-bill. The 7-year 2.1, 10 years 2.35. A swap is a little bit complicated. It's somewhere where it takes some institution figured out that if you took a LIBOR deal, and if you look at it, roughly a 10-year swap is roughly the same as a 10-year treasury. So what happens if there's a bank that only could lend on LIBOR? They don't take an interest rate risk. They can't lend. I'll lend you for 10 years, but it's going to float for all 10 years. I'm not borrowing a floating rate for another 10 years. An insurance cap for the life of 10 years, what may happen? It's going to cost me a fortune. There's some institution there will say, I'll tell you what. Instead, you pay me 2.32%. Okay? And I will give the other lender, I'll pay the other lender. Let's say the loan was done at 0 over. For our argument's sake, the loan was 1% over. So the actual interest rate would be 3.32% for 10 years. This lender says, you pay me 3.32% for 10 years, and I'll give that bank its 1%, and I'll cover the LIBOR change. So month number 1, that third-party company made a lot of money. They made, on a $10 million loan, they made 1/12, right, it's a monthly pay, 1/12, the difference between 2.32 and 0.78. They made a lot of money. The next month, stayed the same, they made a lot of money again. They kept making a lot of money. But if all of a sudden, LIBOR spikes up to 1.8, they also made money, the difference of 1.8 and the difference of 2.32. What happens if the LIBOR goes above that? They start losing money. So there's financial institutions, this is an example, everything's pretty efficient. The 10-year treasury and the 10-year swap is very close to each other. So someone, if it wasn't very close, someone would do something different. They'll buy 10-year swaps, trade it up for treasuries, and make a lot of money just trading currencies, trading debt, trading different vehicles. And that's how these things work out. So if we go back onto page 20, I can take a floating or a fixed rate. A typical fixed rate is 5, 7, or 10 years. The longer the bank is guaranteeing your rate, the more risk they assume. What if rates go up and the cost of funds skyrocket? Therefore, the shorter your term, the lower your rate. So if you borrow money for 5 years today, it's 3 3/4. 7-year money is 4 1/8. 10-year money is 4.5%, and it keeps moving up accordingly for that reason. Sometimes a bank actually lends you money, their own money, and they just decide to charge you that 4%. And sometimes they actually buy treasury bills, and they're not taking a risk themselves. They make their profit margin locked in. But most banks don't buy treasury bills. They use it as a reference that how much they should be charging for 10-year money. Because if the 10-year T-bill is here, and that profit margin should be a certain amount above, that's how they price things out accordingly. Typical amortization is 25 or 30 years. So simply, this can be explained as the length of time to repay the loan. 30 years, with a constant payment schedule of principal plus interest until your loan is paid off. This allows you to pay the same dollar amount every month, no matter how small or large your balance is. That's what we were saying before. If you want to go out and take a loan, you don't want to have your payments 1 month, it should be higher, and the next month lower. You want to say, what are my even payments? If I pay the same amount every single month, and the only thing that's going to change would be the principal and interest, how much is allocated to principal and interest. So quickly, on the next page, that's this constant. If you look at this next graph, and you're borrowing a 4% interest rate, and you're borrowing 25 years, the number that shows up in the center there is 6.33%. That means if you borrowed $1 million, your payment will be $63,000. Fixed every year, divided monthly, obviously, for 25 years, and your balance will be 0. If you want to take the money over 30 years, you only have to pay $57,300 a year per year, because you have an extra 5 years to divide those payments over, right? Very simple. And the simple thing I tell someone, if you owed someone $100 and you have to pay them back within 5 years, every year you're giving them $20. You have to pay them within 10 years, you give them $10 a year. You could lower your payments by averaging it out over a longer period of time. The next page shows this graph of what we just did, of the example of 5.73%, it shows you broken down monthly, your payments can be the same. If you look at the column that's in red, it's $35,860 is your payment on a $750,000 loan. It's the same every single month. What's the difference? In month one, interest is $2,500 plus 4% of the $750,000 divided by 12. That's your payment. What's left over from $35,880 minus $2,500? You have $1,080 left over. Now, but my balance now at the end of the first month is $748,919, not $750. So next month, same payment, the allocation is different. So the 30-year schedule allows you to pay it out a fixed number over 30 years and a little bit of a lower payment because you're dividing out the payments over 30 years. And the only thing that changes on you is how much is used to pay down the loan. When we use the example, by the way, if you look all the way to the bottom right corner before on the IRR calculator, we came back and said $678,000 to pay down because after making payments for 5 years, the 60th payment and all the allocation, what's the balance? The balance is $678,000. So like I said once before, I'll repeat it again because now you're wearing a different hat focusing on these numbers, is that when someone takes out a loan in the beginning, they say you pay mostly interest in the beginning. It's not that you pay mostly interest. You're paying 4% of your balance always for the life of your loan. But most of your payment is interest in the beginning. Look, $2,500 of the $3,500 is interest month one. Month 60, only $2,200 is interest. So that means less of the payment is going towards interest. And if you look this for 30 years, you'll see how the pendulum switches the opposite way. The last month, it's exactly the opposite as the first month. Section 3, page 24. Prepayment penalties. Prepayment penalty. The banks want you to stay with your loan. Most banks have a business model of matching funds. This means when you borrow $750,000, the bank committed the exact same amount of money somewhere else for the same term as the loan. Example, they lent you $750,000 at 4% on a $750,000 deposit, which they're paying 2%. The spread is their profit. The most scientific way that banks used to actually do this, I had a banker who did this. You want to borrow $750,000? Okay, signs the commitment. That day he went to the internet, said I'm giving 5-year CDs, 2%. And the rest of the market's 1.25 or 1. They don't do that. I jump to 2% because he locks it in. Now I know I need 2% profit margin. Like if 4% comes in, I take my 2% from me, I take 2% and I pay the depositors. That's how he actually set up his business to go through it, scientific. That's called matching funds. It happens today also, but much more complicated, much more moving parts. But that's the idea. So they match the funds. Now, when you come back to pay it up early, what happens if tomorrow morning I want to pay back my loan early? Bank says, well, what am I going to do with my $750,000? Today rates are only going for 3%. I have to pay that same person 2%, and I need 2% profit margin. You can't pay it up early. You want to pay it up early? No problem. Prepay me what I'm losing for the next. Well, prepay me 4% a year for the next 3 years. Pay me a 12% penalty. The guy could argue, what do you mean? But you could do something with the money. That's okay, fine. You're right. I can lend out the money today at 3%. So I'll cover your loss of 1%. And that's how loans take place. So that's how the concept of prepayment penalty is. When paying up early, especially if the new lending rates are lower than 4%, they can no longer maintain their cost of funds and profit margin. So some banks will charge a set fee, which gradually decreases. It's called a step down as the term nears its end. And this is the most common one from a bank, i.e. a 5-year term have a prepayment penalty of 5, 4, 3, 2, 1, which means if you want to prepay me in the first year, you could pay up early, and it doesn't have to do with anything that happens with the rates. Rates go up, rates go down. You want to leave me? You're paying me a 5% penalty. Your balance today is $749,000 because after your first month payment, you owe me 5%, $749,000. That's your prepayment penalty. I didn't go through all this work to give you money and do everything. It was in the first year you paid me back. If you are, should have taken a 1-year loan. But done everything planned out accordingly, everything would have been fine. You're screwing up my numbers. But it's really stupid because it's not based on any logic. It's an emotion. This bank could be sometimes in a better situation. I lent you money at 4%, you want to prepay it because you're selling your building and you want to get rid of the loan, and you pay me only 4%, thank God. Now I can put that money out and lend it to someone else at 6%. Still 5%. Same token reverse. Rates drop. Every time you heard people, I'm refinancing my mortgage. Think about what happened. There's no prepayment penalties on home mortgages. That's part of the regulations of the government, Fannie Mae. You go back to a bank on your loan, paying 6%. Someone out there is collecting 6%, they're happy. Also, you say, bank, here's your money back. I want to borrow only at 4%. Someone just stopped collecting 6%, they only start collecting 4% the next morning. Commercial real estate, the bank says, if you ask me to lock for 5 years, you can have a penalty for all 5 years. When we lock for 7 years, a penalty. Typically, it's a sliding scale, 5, 4, 3, 2, 1. A 7-year deal, you just add, they double up the higher years. So it's 5, 5, 4, 4, then 3, 2, 1. That's how they get to it. 10-year loan would be 5, 5, 4, 4, 3, 3, 2, 2, 1, 1. Can you negotiate sometimes flexibility at the end? Sometimes yes, sometimes not, depending on who thinks that they have the upper hand. In a rising rate environment, I personally think banks shouldn't take prepayment penalties. They should want you to prepay back early. They can do something with the money. Their counter argument is, no one's paying me back early anyway. Only if they have to. And if they have to, I might as well make money on it. So there's always that argument that goes back and forth. This means that the first year it costs you 5% of the loan amount to prepay. In year 5, it will cost 1%. And the last 90 days, sometimes 30 days, there's no fee to pay up. Basically, the bank will say, I'm making your loan for you. I know you only have a 5-year loan, so you can't time your next loan exactly on the anniversary. I'll give you a 30-day window and a 60 or 90-day window. If you paid up within 60 or 90 days before, we're covered. And now a multifamily deal, if you were to pay the loan in the beginning of the 4th year, when your balance is 708, your prepaid penalty will be $14,175, which is 2% of your balance. Other lenders, typically Wall Street, charge what's called yield maintenance or defeasance. It takes some work to compute, but essentially the lender collects all the interest it planned on collecting over the life of the loan. Now, it's another calculator built, calculates for you the yield maintenance and defeasance. So I'm going to tell you what's relevant for you to know about yield maintenance and defeasance. From 50,000 feet up, it's the same. The bank is basically saying, listen, you are giving me an interest rate of 4%. You want to prepay this loan up early. I'm fine with you paying it up early. But tomorrow morning, I don't know if I'm going to be in the real estate business when you want to pay me up. The only thing I do know is the United States Treasury bills will be existing. You want to pay it up, there's 8 years left. I'm going to take your money and buy U.S. Treasuries for it. So you don't have to pay me 4% for 8 years at 32% penalty, but you're going to have to pay me the difference, 32%, what I'd make if I put the money into Treasuries. And you're going to pay me that difference. You're going to maintain my yield. The lingo really, everyone says yield maintenance. The word is really yield to maintenance. I'm going to maintain the yield that you're getting. So I tell the bank, you're getting 4%, I'll give you the same 4%. I think you should lend out on real estate. You're not lending on real estate, fine, but you can put the money in Treasury bills, which is safe. So just charge me the difference of what you can put the money in Treasury bills and the loan. Now, it's a little bit more complicated. I told you once, it's not relevant to remember this, just for some people into tidbits of different parts of this course are important to them. They don't actually buy an 8 year. They don't find a Treasury bill has 8 years left to it. They actually find a Treasury bill that was issued 2 years earlier and see what that's trading at today. It's the same thing in an efficient market. An 8-year Treasury, in theory, is probably trading at the same amount that a Treasury that has 8 years left in is trading. It's probably the same thing. But the difference is you pay that difference. But when yield maintenance, you can only lose. The rate's 4%. Your Treasuries are 1%. But the remaining Treasury is 1. You're paying the bank a 3% penalty for the remaining number of years. That's the loss they have. There's 8 years left, it's 24% penalty. What happens if it's the opposite way? We're in the rising rate environment. 10-year Treasury bills skyrocket. The 10-year T-bill goes to 4.1. In yield maintenance, you have no penalty. They'll charge you a minimal fee, a 1% fee, there'll be some fee, but you don't have the yield maintenance, doesn't really kick in. Defeasance is a two-way street. Defeasance from 50,000 feet up allows you to make money. If the 10-year T-bill is at 4.1, they'll allow you to go in reverse and say, okay, take the money, put it to Treasuries. The bank will keep 4%. The bank will say, fine, I'll let you keep that difference, that 4.1. It could be a profit margin. That's how it works. So you can make money. It's not just a one-way street. So people who took loans out, I have a client now refinancing a building. We just wrapped up the building. It's like a $70 or $80 million package. He took out a loan 10 years ago from Fannie Mae. It was the best deal at that time. His rate was 6%. He had the yield maintenance on his loan. So everyone's enjoying the lower rates and wants to refinance because they have a penalty just of 5%, 4%, 2%. You run the math. I pay 2%, but I say 4% a year, 3%. The math, I make a fortune. He was in trouble. Every day he heard the rates got lowered, he'd want to refinance. Yeah, but the prepayment penalty was prohibitive because they were just taking back that difference in the money and he was up the creek. To prepay he had a $40 million balance. He wanted to pay up 3 years early. He had to pay 3% or 4%, 5% a year. So we see what the 10-year T-bill was. 5% a year was the 1-year T-bill was nowhere. So you have to pay 5% a year at a 15% penalty. Yeah, you could pay us back $4 million with a $6 million penalty. Even if it can make sense mathematically to some people, I'm not paying a $6 million penalty. Thank you. And they went on. Some people are scientific. I don't care what. I'm not emotionally attached to my money. Does it make sense to me? It does not make sense to me. Here's another key point, and this is relatively important. It's not really as important to what you're doing, but I'll just explain to you a nuance that it's pretty important. When you're actually paying off a loan with yield maintenance or defeasance. Yield maintenance is actually a penalty. The bank will take your money back with a fee attached to it. Just like take back a prepayment penalty. Defeasance doesn't work that way. What defeasance really does, you're never giving bank back their money. You're just telling the bank, until now, your collateral was my building. You had a $750,000 loan on my building. Tomorrow morning, you actually have to buy treasury bills, stocks, bonds at the same equivalent credit rating. It will throw off the same amount of money. So there's actually a stockbroker concept. We'll go out there, and he'll take the $750,000. If you want to pay it off, he's selling the building. So let's go to the easiest example. I have two buildings right next to each other, identical. Both worth $1 million, both exactly the same. I have a loan on one of them for $750,000. I'm calling the bank, saying, bank, I don't want to prepay it. I want to take my $750,000 and just move it. Instead of this building being the collateral, this building being the collateral. The bank will say yes. That's defeasance. So you're never paying it up. You're putting the collateral somewhere else. But how are you getting a building exactly the same? It doesn't work that way. So he'll say, okay, instead this building, Cha-ching, was throwing off payments every month. And you have the security at the end of the 10 years, you'll get your money back. I found a stock that is throwing off a dividend every year that will give you the same return you want for the next 8 years. And you'll be able to sell the security in 8 years to recoup $750,000. That's how it works. So it's very, very complicated. Of course, there's a company in a business that does it for you, but that's really what's happening. The bank is not getting paid back. So that's why you can make the profit. Because if month number one, it throws off more than the payment of $2,500, it throws off $2,600, you could take the $2,600. You could take the extra $100 for yourself, in theory. If it only throws off $2,400, you have to put in $100. So that's the lie, how you understand from a layman. Practically speaking, they leave nothing to chance. They have reserves and security measures, all the point to get things running accordingly. The last point here on this page here, how to find a deal. It's building a relationship with the sales broker, directing off-market deals, learning as much as you can about the marketplace. I'm not in the business of selling properties. I'm in the business of clearly advising how you're going to find it. I could tell you one thing. The people that find deals are people that are going to hustle and keep looking up and walking down to properties and talking to people and networking and keeping an honest reputation and a trusting reputation. Be honest up front what you can do and you can't do. Because it's not so much between me and you finding a deal. With the internet and everything today, you can find deals sent to you 1 million deals a week. The key thing is what we discussed here, how to screen them right away, focus on the NOI right away at that point. And the flip side of the coin is how to get someone who's going to sell it to you. So between me and you, it's really about building relationships. So from a real estate course, yeah, how to find a deal. You have to know, call a sales broker, call direct off market. You don't want to find a deal. You want to close on a deal. So I told you the math, how to look at things to close a deal. But it's about the relationship. It's about building a relationship with the seller ultimately, or the seller's agent, that when he has a choice of selling it to 5 people, in the same offer that you're bringing to the table, he's going to go ahead and choose you over the other people that are selling it. Thank you. I'm going to be sending out an email later today.